I didn't think I would be the one
Mm-hmm.
that draws us over the line to our first explicit episode. It might happen. So there's
Perfectly
this
happy to
one
feed the
little
beast.
sentence in here, really tiny.
Where is it?
Just says, in addition, commissions and taxes are ignored for the purpose of simplicity.
Or comparing to reality.
That should be the first sentence of the whole. Yeah, compared to for the purpose of reality.
Hello and welcome to Your Business, Your Wealth. My name is Paul Adams. I'm founder and CEO of Sound Financial Group and your co-host here on Your Business, Your Wealth.
Hold on. Sorry. That was a very fine introduction, but I can't even let it go on a minute sooner because folks, friends, and fellow country people, Paul's a little amped up today. I just want to get you ready for this episode. I'm going to let him introduce it because he found the article and he's super stoked. I just hope that I can hang in here with you. I hope you don't lose us. I hope I don't lose us in the course of this episode. So get ready. Buckle up. Paul?
So here's the thing. Cory's just worried this might be one of our this will be our first explicit episode because he's super
I am very much worried about that.
from our show prep that I could end up cursing on the podcast. And Cory, of course, is like, well, come on, it's holiday season. This is not the time to roll that episode out. Fair enough. Now, what has me bothered, upset, wound up are all the theories that float around about what you can do better with your money. And people don't take the time to necessarily research out all of these things. We're going into a presidential election year. And so we have presidential election year theories about investing. We're going to examine one of those that is academically written, that's peer reviewed about what you can do with your money. And we're going to be kind of showcasing that and how it's different. In fact, that whole topic is also this week in planning here at Your Business, Your Wealth. So let's just take a moment and let's brief you on this article. This is out of the Graziato Business Review, a peer-reviewed journal advancing business practice, and is partnered with Pepperdine. So these are, no joke academics around finance. Now,
real sharp people.
Yes.
Real.
Well, and there's presidential elections and stock market cycles, and the author is asking, can you profit from this relationship? And where he lands it is, yes, you probably could. And I think we're going to refute that pretty significantly in this conversation. What they're basically saying in this article is if you bought into the market either at the very start of a presidential term, and then at what point should you sell in that presidential term to maximize your profits with this Standard & Poor's 500 as the proxy that they use in terms of returns.
And here's the thing, guys. This is me calming us down just a little bit because poor Marshall sounds like a great guy. He's who wrote the article. And while he writes, can you profit from the relationship as part of the title, he's not actually writing it from a point of view of here's how you could implement this to your financial life. It's not his job nor his purpose to put this into a format that would make it a strategy for you to actually go run your balance sheet. He's doing academic research, and he did find some curious patterns that are fun to read about. So want to honor him for that. And it's our job to stand in the middle of our clients and our listeners and all the things out there in the mass of the financial world to say, how do you translate this into something that's going to be useful for you? So that I might come back to that topic a couple more times, especially if we do become the first explicit episode on Your Business, Your Wealth. But I feel good enough. I feel like Martin's taken care of enough for us to continue.
Can I go back to being agitating, please?
Please do.
Okay,
please do.
Great.
It's fun. It's entertaining. Yes, let's do that.
Yeah. Cory's exactly right. This guy's job, he's not an investment fiduciary. To our knowledge, he's not a licensed financial professional. And even something we'll hit before we're done is the last line of this article even pulls that out and mentions that this may not be a strategy you should implement. But here is the things that I think are potentially most not misleading from the standpoint that he chose to mislead you, but the omittance of certain information leaves it misleading. And it's the non-comparative analysis. Now, here's one of the things I want to point out, and this is important for all of us, especially in an election year, is going back to something we spoke about on prior podcasts about the Gell-Mann Effect. Now, the Gell-Mann Effect is that when you read a periodical, like it could be an academic peer-reviewed journal, it could be a newspaper, an article online, or something like Forbes, etc., and you're reading through and they're writing about something that you're an expert in, engineering, client relationship management systems, could be, in your case, could be a political thing, whatever it is. There's an area that you are an expert. You read an article about the area for which you are an expert, and you read it and you go, this is full of garbage. This is inaccurate, incomplete, insufficient. Okay. I'm not saying that I'm saying that today. I'm saying you might say that when you read an article that is on a topic where you are an expert. Okay. But then you'll turn the page and there'll be something about the impeachment hearing. Now, you just read an article where proof positive that journal you're reading did no sufficient work in fact-checking the things for which you were an expert. But then we turn the page and it's about the China trade deals, or we turn the page and now it's about finance, or we turn the page and now it's about accounting, an area for which maybe you're not an expert. And you instantly have amnesia and you read the next article as if that journalist is equipped to talk about the thing that you just did.
Or maybe it's like they know so little about the thing I know a lot about, and they've got to know something about something. So this must be the thing they spent all their time researching and didn't research what I know about.
Right. There's all kinds, but the funny thing is we don't even consciously work that through. What we do is we just turn the article and assume the next one's an expert. Now, in this article, it's very easy, especially because of the authority of we have somebody who's written, this is peer-reviewed, we're in an academic journal. So it's also easy to just accept this article and anything you would take away from it as unquestionable academic authority. So let's just scroll down here, because I think one of the things that are most important to take out of this is he talks a lot about market performance since the 1940s, but his actual test doesn't go into place until the 1950s. But here's one of the things that I think is most trying. Number one, the first part of this test is he's going to do percentage change from October 1 of the second year of a presidential term through December 31st of the election year. And then he's going to do the percentage change if you bought in at the beginning of the presidential election year, but you sold out September 30th of the second presidential year. So it's a little bit like which part of somebody's presidential term are you going to buy into? Now, one thing that just immediately jumps out to me here, not a big deal, but October 1 of the second year of a presidential term through December 31st is 27 months. Percentage change from January 1 through September 30th of somebody's second year is... how many months is that? 22? So it's less months. And one of the things they're going to find is this scenario number 2 gets more return. So by the way, hold on here for just with me for a moment. We are going to get a touch analytical because we do need to ground some of these topics. What I promise is when we get through the parts of the percentages, etc., don't tune out. I'm going to land each one with like the conclusion so you can walk away from it. Long story short, every time this is being studied in one scenario, it's 27 months. Every time it's studied in the other scenario, it's 22 months. And then they're going to compare those over time.
And so the overarching strategy is buying in sometime before the election and selling out sometime after. Am I reading that right?
Exactly right.
Okay.
Exactly right. Yep.
And then money staying out of the market until the next election.
Mm-hmm.
Like just staying in cash. Okay.
That's exactly right, Cory. What he's doing is taking the Standard & Poor's 500, investing money in it, and then changing which period of time he sells or buys into the Standard & Poor's 500. Now, you might wonder, how did I run across this article? Well, what we've talked about in terms of reading financial media in the past is click the hyperlinks to the data that they use, because this came out of another article talking about stock market performance during presidential election years. And all I had to do was click on this 2010 paper he based his article on. But this is one of the biggest things that got my attention. He says if you examine the returns of the S&P 500 for each of the 23 election years since 1928, you'll see that only 4 of them it was negative. So let's pause there for a moment. What's the impression that you're left under as a reader in reading that is, oh, presidential election years must be less likely to have a down year than any other year because he's
like
using...
They're safer. They're safer to invest in that year.
Exactly. Yeah, it's only down this much. But what you might find interesting is he's mentioning that only 4 were down since 1923, or 1928, if you only count election years, which is only 23 years, which is 17.39%. Okay. Now, you'll know why I'm giving you the 0.39 in about 1 second. Because if what I did instead is I just looked at another spat of time that'd be easy to look at, which is just since 41 years, 1978, basically. The S&P 500 has averaged, if you just stayed in it the whole time, weren't picking election years, etc., 17.07%. Now, the reason I wanted to give you the slight distinction of the decimals is they're both basically 17% and didn't want you to think I collapsed my data. But the thing is, it's leaving us on the impression that these are somehow maybe safer years or better years to invest. Except it's about the same as investing all the time if all you did was own the Standard & Poor's 500 index. So what we have to consider is, what is it he's saying this is going to do for us? Well, his assertion... Go ahead.
I think we don't want to miss what just happened there, which is a giant question that anybody can ask in reading any article, which is, well, how does this compare to the next easiest no-brainer thing I could do? If I'm going to do all this work, how does it compare to just, letting my dog pick my stocks for me?
Exactly. Or the monkey at a dartboard. Yeah.
That's monkey in a dartboard.
This here is why we click through articles, because sure enough, what we see is, number one, no contrasting strategy compared, which is totally normal. Haven't you noticed when you meet with many people that are licensed financial representatives or whatever they refer to themselves as, most of the time it's not a comparison of 2 strategies you get. It's a sales narrative about one strategy and why to buy it. And that's usually how these articles are shaped up too. But what they're doing is back to 1952 testing, do you own from the last 27 months of a president's 4-year term or the first 21 months of their presidential term, which I saw 21 months listed later, so I was just doing the math wrong in my head. So now we get down to 2000. So this is just from 1952 through 2000, had you invested the money every year. And I will tell you, the results, quote unquote, look amazing. Look amazing. Let me show you the graph. This is a pretty cool graph. This is, if you had done what Investor 2 did, your money basically decreased since 1952 through the end of 2000, meaning you had a negative rate of return on average every year, taking your $1,000 you originally invested and decreasing it down to about $640.
I don't want that at all.
Yeah, that sounds like
awful.
A terrible idea. Let's not do that. Let's do this strategy instead, that I put in $1,000 and it grows to $72,000. Now, pause right there. We've covered this when we talk about real estate, because it's just the beginning price and the end price and nothing that you've journeyed in between, and it really looks like it must be a great investment. Well, let's just examine it a little bit. Here is the return if what you did is exactly what this article says to do, is you do their investing strategy, which is you only invest during certain parts of a presidential term, which means your money is sitting in cash in between those deals. You start with $1,000. And despite, now here's the other piece that's important to point out. I'm just going to scroll this in the background for those of you watching online. Look at how high these positive rates of return are. Just crushing it. I'm going to read those for those of you listening. 1952, 35%. 1956, 45%. 1960, 16%. 1964, 52%. 1968, 39%. Like over and over again, these are just returns that are slaying it.
Paul, I'm thinking what all of our listeners are thinking, which is, well, let's see, 1,000. Let me put 100 grand together, and that's 7.2 million. Not this piddly 72,000. That sounds like a good plan.
And it's super simple. I got this couple of page long paper from this academic, and I'll just do what he's mentioning to do: buy in a certain time, get out a certain time, and at least historically look never a negative return. In fact, I put in $1,000, it grows to $72,000. Again, that's that scaling problem because we run into a situation where it feels like a lot more than it really is. So what's the actual return? The actual return for this strategy, investing $1,000, then 48 years later having $72,000, is 9.34%. Now, number one, the article never tells you the rate of return of this strategy, except to tell you the returns in the given year that are sweet, large, and double digit. What were you gonna say, Cory?
I'm getting a little angry over here. I'm getting a little ticked.
I love it.
I didn't think I would be the one that draws us over the line to our first explicit episode. It might happen. So there's this one little sentence in here, really tiny.
Where is it?
Just says, in addition, commissions and taxes are ignored for the purpose of simplicity.
Or comparing to reality.
That should be the first sentence of the whole. Yeah, compared to for the purpose of reality. I mean, so let's assume that you're doing this not in an IRA, and there's capital gains taxes involved. Capital gains taxes were, what were they in the 70s? They were something like 49%, 59%.
They were high.
Like, they've been much higher than they were today. But even if they were only 15 or 20%,
some of the lowest capital gains rates we've ever been in right now. Some of the lowest. But this strategy goes back to 1952.
You either have fees and trading costs in an IRA account or a brokerage account, plus you have some sort of capital gains taxes if you're in a brokerage account. So all I know for sure is 100% it is not as high as that 9% number.
Yeah, even if you got the 9.3%, the simple fact that you're totally liquidating the portfolio on the December 31st of every election year would significantly erode the returns you would otherwise enjoy. But at least, let's just take him from his word at the article. If you could hold it the entire time, 1,000 grows to 72,701, 9.3% rate of return. Okay? Well, here's probably what a scientific mind would ask. And what you might ask is, Paul, if you could message me right now, could you just show me what the S&P 500 return would have been if we wouldn't have been monkeying with it, trying to get in and out of the market? Because he gives us this scenario of basically owning the back half of a president's term versus the front half of a president's term, but never gives us...
There's a joke in there about owning a president's front half and back half. I don't know. We'll figure it out for next time.
But the thing is that it's... What if you didn't go through all the trouble, all the difficulty, all the extra taxes of selling at a... No wonder it's not talked about in the article, because if you'd have just held the S&P 500 for the entire time, the average rate of return, if we average the years together, would be 13.75. But even actual rate of return, which we've talked about the difference before on the podcast here, is 12.48%. Let me shape that up. That means for every 1,000 you invested, instead of it growing to 72,000, every 1,000 you invested would have grown to $318,000. Doing nothing. Like, that's the person that just blindly buys the S&P 500 and then promptly gets lost in the jungle for 42 years and then pops back out and like, how's my account doing? They're like, well, you haven't filed any taxes. So we got to have a conversation with the IRS. But other than that,
Winkle portfolio.
Yeah, it worked out.
Okay.
You didn't have to monkey with it. You didn't have to play with it. Now, we don't advocate people just go out and buy the Standard & Poor's 500. It's way too concentrated and not properly diversified portfolio of 500 of mostly growth, US-based large cap stocks. So not the best thing to just put your money into. But this guy's saying bounce your money in and out of the S&P 500, but not completing the story by simply saying if you'd owned it and not done any of this monkey business, you would have literally still had 12.48% return, which is not like, oh, it's a little bit of difference over 42 years. That difference amounts to $250,000 more wealth on $1,000. So let's examine one more thing here, and then we will go to commercial and bring this all together for you. Let's instead take a look at what if we just analyze this for somebody's normal investing career, like 20 years? Well, we did the math on their strategy if you just did it since 1980. Seems reasonable. And really, we wanted to be fair to this paper to say maybe it would have worked out differently. So let's just bring back up his paper, and I'm going to show you what it might have looked like from 1980. Look at this, 32% positive, 37% positive, 19% positive, 38, 60. And then in year 2000, up 34%.
Thank you, Reagan.
Yeah.
Thanks, Gipper.
So here's the thing. What was the money value in 1980? $15,072. Well, if we just grew it for 20 years, 1980 through 2000, where it's 72,701, we would have an 8.1% rate of return. Using the presidential election timing strategy written about in an academic journal, peer-reviewed. I'm going to have to, after this, I'm going to look up peer-reviewed because I'm pretty sure it means people just checked your math but didn't check the applicability of the article or whether or not it was complete. So we're going to go back now to the history of the S&P 500, and I'm just going to take it from 1980 through 2000, and the actual rate of return of the S&P 500 over that same 20-year period of time is not 8.1% as the strategy said it would be if you did their really cool thing of moving in and out and getting all these really high double-digit rates of return, just not all the time. Instead, the S&P 500, if left alone, would have been 16.38%. So instead of growing 15,000 to 72,000, you would have grown 15,000 to whatever 15,000 is times 24. It would just be enormous. A lot more. Like it would be 24, like 360,000-ish if you started with 15,000 in 1980, whereas his strategy would have you 15,000 to 72,000. Again, scaling problem. And this is why what we want you guys to be able to do is either be in a spot where you teach yourself enough about money you can do this math yourself, or put us in the position where you're working with us or someone like us that can just help coach you on how to, well, does this strategy work or not? So if you're a client of ours and you look at a strategy like this, just bring it to your next conversation with us, and we will help you do the testing. If it's a better strategy, we're going to be the first ones to tell you to do it. Okay.
All right.
I need to take a breath.
That's a good time for a commercial. We have not yet crested over into our first explicit episode, but we have come close. Who knows what'll happen when we come back from commercial? We'll see you after this short message from Sound Financial Group.
Hey, everybody. I had to interrupt our show for just a moment to share with you something new. We've designed a new white paper that we think is going to add you value in the way that you think about money. It's 3 of the biggest mistakes we see people make and 6 ways to fix them. Now, for some of you, you might not want the white paper. You might be ready to have a conversation with us, and that is okay. You can email us at info@sfgwa.com. That's info@sfgwa.com. Find us on the web at yourbusinessyourwealth.com. And anytime on any of our social media platforms, send us a message and we can get you this white paper. But in the meanwhile, if you want to just skip over the white paper, have a philosophy conversation with us, we're happy to do that with you. Just let us know philosophy conversation in the subject line. And if you want this white paper, just put white paper in there and we'll immediately get out to you this white paper on the 3 biggest mistakes that we see people make and the 6 things that you can do to fix them. And now, back to our show.
All right, welcome back to our wild and wide-ranging review of a wonderful academic white paper that we're really concluding is not applicable to our specific financial lives. And here's the thing, guys. At the end of the article, final thoughts is the last couple paragraphs. He even says it himself. So, some highlights are, it's not the intent of this paper to forecast the market, even where patterns exist. There's enough variability that it's risky to try and to anticipate specific returns. And however, just when you think you've figured it all out, you find another pattern that can suggest different possibilities. So he is coming clean for himself at the end here, or just setting the context. Like, he's not even trying to help you put an actual investment strategy together. And I think that's really, really important. And Paul, I think you've got some other thoughts for what folks can do.
Well, but here's the problem. That should have been the first line of this article. The
Agreed.
First line of this article should have been, this is not an investment. Because, by the way, if you've read this whole article, if you're actually reading through, looking at his data, all that, where do you land by the end of it? Where has your framing gone? Where is your mental headspace? In all likelihood, you're sitting there going, well, this is a presidential election year. So what I'm going to do, I'll go out of the market at the end of this year, and then I'll wait until October 1st. I'm doing the math, and where would I keep my cash? And then this final thoughts thing, and except you're reading his final thoughts through the filter of having already partially applied the strategy to your future. It's not saving anybody on the back end. This is general financial services and academic industry CYA. But when you see a CYA this big, it's a really good idea to see your A also. So here's what I mean by that. You look at this, there's an outside event. There's going to be a presidential election. And based upon that, you can predict the market. There's a China trade deal. And based upon how that's going, we can predict the market. There's a weather system moving into the Midwest that's going to have record cold, record heat, some kind of drought, and you can trade it. Like, there's articles on every stripe saying what you can do to beat the market. Why? Because nobody wants to have the conversation that none of these active managers, none of these strategies can consistently or predictably been proven to work, including this one in an academic journal. His last line is, however, trying to figure out such patterns can certainly make life interesting. Yes, but implementing them can make you significantly more poor on a consistent and predictable basis. Now, for what we're thinking about is that there's all these outside situations where somebody's saying, because this is happening, this is what you should do with your investing. Because this is happening, this is what you should do with your investing. And they're constantly trying to market to you a set of strategies for what you should do to your future. At least this gentleman back tested it and gives you all of the data. Most of the articles you could read don't give you that level of data. For instance, the article that led me to the white paper didn't go this deep on the data and just kind of left it out there and hanging. So here's what I think all of you can do listening. We don't want to leave you hanging. You want to be in a position that when you're reading articles like this and you see an interesting idea, set up a folder on Google News you can save it to, or send an email to yourself, send an email on it to your advisor and coach. And I say that very specifically if you have an advisor and a coach around things financial, not a financial product salesperson, which is different. We've talked about that before. Get somebody who can coach you, help you do the math, and do the kind of double checking with their financial tools on a strategy like this one, where all we had to do was look for the dog that wasn't barking. There's a Sherlock Holmes piece that talks about, well, I know that this resident who was murdered by someone he knows because no one reported the dog barking. The dog that wasn't barking in this article is the thing that's harder to see, which is what would the S&P 500 have done if we just didn't do anything? And I've got some kind of silly news for you. a 70% stock, 30% back-tested bond-only portfolio was like 14.04% since 1980. Meaning staying academically allocated and globally diversified did better than even the S&P 500 and way outperformed this unique strategy of trading in and out based upon where the market's going. So our encouragement for all of you listening today is capture these articles, read financial things. This is not to read any of them. They will contribute to your thinking, but what's going to contribute to your thinking even more is if you're a client of ours, if you're not a client of ours, email us, info@sfgwa.com. We'll at least have a short conversation with you, see if there's any reason for us to talk further, but find someone who can help you do this math, not to tell you that's a dumb article, not to give their opinion, not to cajole you for listening to this, or they just throw in an overcoming of objection the way the financial services industry teaches them. Instead, somebody who's going to do the math with you, help you understand it, just like we did here on the show today, and put you in a position that you can better understand each financial decision you're making, because all of that knowledge builds as you ground one assessment, ground another, you get better financially. So definitely take these in, share them with whoever your coach is, share them with us, and we'll be happy to pull apart some of these articles, pull apart some of these academic theories about investing, and find out if it really works, and more importantly, does it really work for you?
I am so impressed. I am so relieved. This is not the time that we crossed that line, as they say. Well done. Before we end for today, we have another great featured review that I am really excited to read for you all. This is from Amin L, whose title is Please Publish to Spotify. Great podcast with a wealth of honest advice that isn't discussed elsewhere. Please publish to Spotify so I can listen on all my devices. Well, Amin, my guess is by the time you hear us reading your review, you'll be listening to it on Spotify. So thank you for that recommendation. And we also want to remind everyone, these reviews help us more than you could know, and we would like to, encourage you to do that by offering a book of your choice: Clockwork by Michael Michalowicz, Paul's book, Sound Financial Advice, my book, Cape Not Required, any of them that you want, just by leaving an honest review. Send us that screenshot to info@sfgwa.com along with your address, and we'd love to say thanks for just getting on there and helping more people hear your review of our episode. Paul?
With that, Jordan, since he's here doing all the video switching and engineering, is certainly going to get it on Spotify. I'm sure by the time you get this review, that's my way of making sure Jordan does it.
It is on Spotify.
It is on Spotify. It's already done. Jordan literally read the review, got ahead of it, already put it on Spotify. We didn't even know. God bless you, Jordan. With that, it was great spending time with all of you today. Thank you for putting up with our antics, and we hope that we make it fun to learn about finance. But more importantly, we just hope we've offered you something today that's going to contribute to you being able to design and build a good life. Hey everyone, hope you enjoyed watching that video, tuning in. We love having you guys here. Don't forget to like that video, subscribe, and hit the alert bell. But by the way, if you just have questions and you want to dig in and learn a little more, go ahead and email us at info@sfgwa.com. Put yourself in the position to have a 15-minute phone call. I mean, come on. Can your current plans withstand a second opinion? If not, that might be the very reason to reach out.